Trulieve Cannabis Corp beat Q2 2026 EPS consensus. They posted adjusted earnings of 11 cents per share, and that's against the expected 6 to 8 cents.
Right, but top-line revenue came in at $271 million, which is actually a slight miss compared to the $272.2 million Wall Street was forecasting.
Yeah. And looking at the guidance, Q3 revenue is projected to be completely flat compared to Q2's medical-only revenue of $222 million. Plus, they dialed back full-year 2026 operating cash flow guidance to $225 million.
Which is down from that previous $250 million estimate.
Exactly. While at the same time, they're raising CapEx to $95 million.
And, despite an initial 5.6% pre-market pop on that EPS beat, the stock actually slipped during regular trading. It closed down roughly 2.78%, right around $8.75.
So those are the headline numbers. But the mission of this deep dive for you today is to really look past those top-level figures. Because reading Trulieve's Q2 income statement right now feels like staring into a financial funhouse mirror.
It really does.
We need to unpack the massive accounting noise in this report to figure out if the underlying medical business is actually a buy for retail investors. Because, if you open the report, the very first thing that jumps off the page is this staggering GAAP net loss of $406 million.
Right, and contextualizing that $406 million GAAP loss is really the only way to understand this quarter. Because retail markets see a massive negative number like that, and they immediately hit the sell button. Right?
Absolutely, panic.
Exactly. But you have to look at the cash flow statement and the structural changes they made to the business. The driving force behind that massive loss is actually a $407 million one-time charge.
Right. It's non-recurring.
Yeah, non-recurring.
No.
Trulieve basically executed this huge strategic maneuver to carve out and deconsolidate Harvest.
And Harvest is the subsidiary housing their mixed-use state operations, right?
Right, meaning states where they sell both medical and adult-use cannabis.
So let's break down the mechanics of why a highly profitable company takes a voluntary $407 million accounting hit. This all ties back to the regulatory landscape and the New York Stock Exchange.
Yeah, the uplisting.
Exactly. Following the federal rescheduling of state-licensed medical marijuana to Schedule III, Trulieve saw a distinct opening. Because the NYSE has very strict rules, they will not list any company that touches the cannabis plant for adult use.
Because adult use remains federally illegal.
Right. However, medical marijuana, operating legally under a Schedule III federal designation, actually fits within their listing parameters.
And so by isolating its DEA-registered medical-only business, Trulieve became the very first U.S. plant-touching cannabis company to list on the NYSE. But to comply with the exchange's rules, they had to legally and structurally segregate those Harvest adult-use assets.
Right, they had to carve it out.
Yeah, so they sold 10% of that mixed-use business to an independent third party.
And this is exactly where that GAAP accounting funhouse mirror effect comes in. Because, selling just 10% of an asset doesn't normally wipe the entire thing off your balance sheet.
No, not usually.
But in this specific transaction, Trulieve deliberately forfeited operational control and board seats to that independent third party. And when you surrender voting control, generally accepted accounting principles mandate that you can no longer consolidate that subsidiary's financials into your own.
Right, it shifts. It goes from being a consolidated subsidiary to an equity method investment.
Which is huge.
It is, because that structural shift triggers a mandatory revaluation. You have to mark that asset to market based on the new ownership structure, and that is what forces that $407 million non-cash write-down.
So the cash didn't actually leave the building?
No, not at all. The value was just recategorized on the balance sheet. In fact, if you strip out that one-time Harvest charge and look strictly at the continuing medical-only operations, Trulieve's adjusted net income was actually a positive $20 million for the quarter.
Okay, but I'm going to push back pretty heavily on management's narrative here.
Sure.
If you're a retail investor, accepting a $407 million loss as mere accounting noise requires a massive leap of faith.
Yeah, it's a tough pill to swallow.
Let's look at the operational reality. Adult use cannabis is where the massive, scalable consumer volume lives. Amputating a high-growth, high-volume appendage just to get a prestigious ticker symbol on the NYSE, it just seems incredibly risky.
I see what you're saying.
You're essentially shrinking your total addressable market just for a slight decrease in your cost of capital.
Well, shrinking the top-line addressable market is definitely a valid concern, and honestly, it undeniably contributed to the stock fading after that initial pre-market pop. Investors are absolutely weighing the loss of that adult use volume against the efficiency of the operations they kept.
Right.
But if you analyze the unit economics of the retained medical-only segment, it reveals exactly why management took the gamble. Medical-only revenue hit $222 million, which is a 4% sequential increase.
Okay, that's not bad.
But the gross margins, that's the most compelling defense of this strategy. The consolidated gross margin before they carved out Harvest was 60%, but the medical-only gross margin is an impressive 63%.
Oh, wow. So it actually went up, and adjusted EBITDA for that medical segment came in at $98 million, yielding a 36% margin.
Exactly.
Furthermore, their retail dispensaries account for 94% of their total revenue, meaning they're capturing the full margin from seed to sale, rather than, relying heavily on wholesale. So the core business they actually retained is operating with extreme efficiency.
The operational leverage in the medical segment is just demonstrably stronger. Management attributes that 63% gross margin to highly optimized production costs, mature economies of scale, and this is key, highly disciplined promotional environments.
Meaning less discounting.
Right. Medical markets generally don't devolve into those aggressive race-to-the-bottom pricing wars that you constantly see plaguing oversupplied adult use markets.
Yeah, that makes sense.
So the profitability profile of the medical assets sitting on the NYSE today is just structurally superior to the blended operations they had yesterday.
Okay, let's follow that profitability metric directly into the cash flow statement then, because this is where the federal policy shift gets very real for their balance sheet.
Oh, absolutely.
The federal rescheduling to Schedule 3 means that the highly punitive Section 280E tax no longer applies. And for anyone holding cannabis stocks over the last decade, 280E has been the absolute bane of the entire industry.
The grim reaper of cannabis cash flows?
Exactly. Think of 280E kind of like running a marathon.
Right.
You're running the race, you're pacing well, but the IRS forces you to wear a 50-pound backpack the entire time.
That is exactly what it felt like for these companies. Or, to use a business example, it's like running a bakery. But the IRS tells you that you are only legally allowed to deduct the cost of your flour and sugar.
Yes. You aren't permitted to deduct your rent or your cash registers, your marketing, your employee salaries, none of it.
Right. Section 280E forced cannabis companies to pay federal taxes on their gross profit rather than their net income. It was an incredibly heavy, structurally unfair tax burden that just strangled cash generation across the whole sector.
So they were basically profitable on paper, but bleeding cash in reality.
Exactly. Companies were frequently generating massive operating profits, but ending up with negative cash flow after paying those massive 280E tax bills.
So taking that structural tax burden off changes the entire mathematical foundation of the business. I mean, Trulieve's CEO, Kim Rivers, explicitly stated that removing this tax provided an immediate massive boost to reported net income and cash flow.
And you can see it in the numbers. The Q2 operating cash flow hit $53 million, bringing the first half of 2026 to over $108 million.
That's huge.
Yeah, and free cash flow for the quarter was $32 million.
Generating $32 million in free cash flow in a single quarter is a total rarity in the U.S. cannabis space. And that flow through to the balance sheet provides a massive strategic moat. Trulieve ended the quarter with $325 million in cash versus $289 million in total debt.
Right, so they're operating with a net cash positive position of $36 million.
Which is wild for this sector.
It really is. In an industry where access to capital has historically been restricted, highly dilutive, and just incredibly expensive, having that net cash position gives them a distinct advantage over heavily leveraged peers.
And that strong net cash position clearly gave the board the confidence to authorize a share repurchase program, right? For up to $50 million. Or roughly 8.5 million shares.
Yeah, and management teams do not authorize aggressive buybacks like that unless they possess absolute certainty that their underlying cash generation is secure.
Right, and they have to believe the current share price fundamentally undervalues the assets.
Exactly. Removing that 280E tax drag and securing the NYSE uplisting fundamentally alters their capital structure. The uplisting is expected to systematically lower their cost of capital by, attracting this massive pool of institutional investors, pension funds, family offices.
People who literally couldn't buy them before.
Right. People that were previously restricted by internal compliance rules from purchasing OTC cannabis stocks.
So Trulieve has $325 million in the war chest. They're buying back stock. But they also raised their CapEx guidance to $95 million for the year. And you don't raise CapEx unless you have specific high-return markets ready to absorb that capital.
Very true.
Which brings us directly to their primary growth drivers, Georgia and Texas. Let's look at the mechanics of Georgia first, because the regulatory evolution happening there is completely reshaping the market.
Georgia has essentially opened the floodgates for their medical program through recent legislative changes. The state legislature removed the previous highly restrictive THC caps, and they expanded the list of qualifying conditions to include major categories like HIV, lupus, and irritable bowel syndrome.
And historically, whenever a state expands qualifying conditions and removes potency caps like that, the market experiences an immediate, violent inflection in patient enrollment.
And that inflection in Georgia was immediate. Trulieve reported that their dispensary traffic in the state literally tripled in the first 2 weeks of July alone.
Tripled in 2 weeks.
Yeah. The demand surge was so aggressive, they actually sold out of flower.
They ran out of weed.
Literally. They are currently rushing to expand their cultivation footprints and roll out new vape products just to meet the demand. But the most disruptive element in Georgia isn't actually the dispensaries.
Right.
It's that they are now supplying nearly 20 independent pharmacies.
Which is such a fascinating model, tapping into existing healthcare infrastructure.
It's a massive capital-light unlock for the company. Georgia legislation allows independent local pharmacies to register with both the state and the DEA to dispense medical marijuana directly to patients.
Wow.
Over 125 independent pharmacies across the state have already expressed interest in the program.
So by doing that, Trulieve effectively turns local pharmacists into their budtenders. They secure this widespread distribution network without having to spend millions in CapEx to build a standalone Trulieve dispensary on every corner.
Exactly. And the state just crossed 45,000 registered patients, which actually triggered Trulieve's legal eligibility to open an 8th standalone dispensary to sort of complement that pharmacy network.
So Georgia is clearly ramping at an incredible pace, but management's commentary makes it pretty clear they view Texas as the crown jewel of their long-term thesis, right?
Oh, without a doubt. CEO Kim Rivers explicitly labeled Texas the largest medical cannabis opportunity in the U.S.
Which is saying something.
It really is. Currently, Texas has roughly 157,000 patients enrolled in its compassionate use program, which represents a mere 0.5% of the state's total population.
That is tiny.
Barely scratching the surface. Management model that if Texas eventually reaches the 4% penetration levels that we currently see in mature medical markets like Florida or Pennsylvania, the state would house 1.3 million active patients.
And Trulieve is aggressively positioning for that Texas expansion. They're currently converting their conditional license to a final license and have already completed the initial phase of their production construction.
Yeah, because Texas recently revamped its famously strict program. They added chronic pain to the qualifying conditions. They started allowing telehealth consultations for initial doctor visits. And they removed these draconian rules that previously forced operators to warehouse all their products overnight.
Wait, instead of just leaving them in the stores?
Exactly. They used to have to move them every night.
That's insane.
Right. So shifting to allow telehealth and adding chronic pain, those are the two specific regulatory levers that turn a restrictive, purely symbolic medical program into a highly viable commercial market.
But I'm going to challenge the underlying assumption of their Texas dominance here.
Okay, let's hear it.
The Q2 report proudly notes that Trulieve sold 1.5 billion milligrams of oil in Florida, which is double the volume of their next closest competitor.
It's a massive lead.
Right. They completely dominate the Florida market, but they did that because they secured a massive first-mover advantage in a vertically integrated state years ago.
Sure.
The landscape in Texas is entirely different today. Texas is currently issuing 12 new licenses, which brings the total number of operators in the state to 15. So realistically, can Trulieve expect to replicate that monopolistic Florida scale in Texas when they are facing an incoming wave of new, well-capitalized competitors?
It's a fair question. Replicating a first-mover monopoly is inherently difficult, but Trulieve's specific strategy in Texas leverages the unique regulatory framework of the state.
How so?
Well, when analysts asked if Trulieve would utilize a wholesale model in Texas to supply competitors, Rivers stated they are leaning entirely into their proprietary branded retail playbook.
Meaning they just want to own the stores?
Exactly. Texas regulations allow for unlimited production capacity and unlimited retail locations, provided the operator maintains at least one physical presence in each of the state's 11 designated regions.
Oh, I see. So because there are no arbitrary state caps on the number of stores a single company can open, Trulieve can deploy that $325 million cash pile to simply outbuild the newer licenses.
Precisely. The new operators have to spend their initial capital just standing up cultivation facilities and basic infrastructure,
Right. Starting from scratch.
while Trulieve is betting that their existing capital efficiency and massive economies of scale will allow them to modularly expand their retail footprint way faster and wider than competitors who are starting from absolute zero.
Okay. Throwing capital at an unlimited retail footprint in Texas is a solid long-term thesis. I'll give you that. But it doesn't address the immediate short-term headwinds that caused the stock to drop nearly 3% following the earnings release.
No, it doesn't.
The market is aggressively forward-looking, and the guidance provided in this report gave institutional investors several reasons to pause.
Yeah, the guidance certainly explains the pullback. First, top-line revenue guidance for Q3 is entirely flat. Yeah, when a growth-oriented stock tells the market to expect zero sequential top-line growth, momentum just stalls.
Yeah, it kills the vibe entirely.
And second, as we touched on earlier, full-year operating cash flow guidance was cut from $250 million down to $225 million.
Right.
Now, management directly attributes this $25 million haircut to the Harvest deconsolidation, losing the cash generated by those adult-use assets. But regardless of the strategic justification, a mid-year cut to cash flow guidance is just rarely rewarded by the market.
Exactly.
Yeah.
Furthermore, even within their most exciting high-growth markets, there are immediate execution risks. I mean, we just discussed how demand surged in Georgia and they sold out of flower.
Right.
While surging demand sounds positive, severe supply constraints mean Trulieve is actively leaving money on the table right now. If a patient visits a dispensary or a pharmacy and the shelves are empty, that patient will seek alternatives.
Yeah, they're not going to just wait around.
Yeah.
Management actually explicitly called out the unregulated intoxicating hemp market as a primary competitive threat.
Right, the hemp loophole.
Exactly. If you can't keep regulated medical flower on the shelves in Georgia, consumers will simply walk into a gas station and buy a loosely regulated Delta-8 or THCA product. The hemp loophole is cannibalizing the regulated market across the entire country.
So the competitive drag from unregulated hemp derivatives is obviously a significant growing risk impacting all multi-state operators. However, the largest immediate drag on Trulieve's market sentiment this week wasn't operational or regulatory.
No, it wasn't.
It was entirely optical. The insider selling activity requires really close examination here.
Oh boy. Yes, it does.
This is the massive red flag that retail investors are aggressively debating right now. Immediately following the highly anticipated NYSE uplisting, which is the exact catalyst investors had been waiting years for, CEO Kim Rivers sold nearly 1.7 million shares, valued at roughly $14.66 million.
Yeah, it's a big number. But to accurately evaluate that sale, you really have to understand the mechanics of executive compensation and trading regulation.
Okay, walk us through it.
This transaction was executed under a prearranged 10b5-1 automatic disposition plan. Executives establish these plans months in advance, and they set predetermined schedules or price triggers for selling shares.
Right.
The SEC created 10b5-1 plans specifically to allow insiders to liquidate equity without facing accusations of insider trading based on non-public material information.
So she wasn't just panic selling on the day.
No, not at all. This specific sale was the execution of the first tranche under a plan established well before the uplisting ever occurred.
Okay, I fully understand the legal mechanics of a 10b5-1 plan, but the optics are still absolutely brutal for retail shareholders.
Oh, completely.
I mean, how is a retail investor supposed to hold strong through a $406 million gap loss and flat Q3 guidance when the chief executive is taking almost $15 million off the table during the very first week of the NYSE listing?
Yeah, it's a fair point.
To see the CEO dump a massive block of shares directly into the liquidity event created by the uplisting, it just creates terrible behavioral sentiment, regardless of whether a lawyer scheduled the trade 6 months ago.
The disconnect between fundamental reality and behavioral finance is incredibly stark here. From a purely fundamental perspective, her pre-scheduled stock sale does not alter the impressive 63% medical margins. It doesn't reduce the $325 million in cash, and it doesn't change the removal of the 280E tax burden.
Sure.
But from a behavioral perspective, it acts as a massive wet blanket on retail momentum. Investors desperately want to see management eating their own cooking.
Yes.
When a company is aggressively pitching a turnaround narrative based on federal rescheduling and new exchange access, and the captain takes a $15 million lifeboat off the ship just as it enters open waters, the passengers naturally get nervous.
It definitely caps the upside momentum in the short term. But if you look at the consensus view from Wall Street, the institutional analysts covering the stock do not seem overly deterred by the insider sale or the flat guidance or the GAAP net loss.
Not at all.
There are currently 7 active buy ratings on the stock, with an average 12-month price target of $18.71. That target represents over 113% upside from current trading levels.
Institutional analysts are clearly stripping out the accounting noise. They're looking past the non-cash harvest write-down and focusing heavily on the long-term structural advantages.
Right.
The permanent removal of the 280E tax penalty, the unique DEA medical registrations, the highly defensive market share in Florida, and, like we talked about, the massive optionality of an unlimited footprint in Texas.
Which brings me to a final, slightly provocative thought for you to mull over as you evaluate this company. We spent a significant amount of time unpacking that $407 million charge to carve out the harvest adult use operations, just to comply with the NYSE.
Yeah.
Trulieve sold 10% of that business to a third party to trigger the deconsolidation. But they retained 90% of the economic interest in those massive adult use assets.
That's the kicker.
And crucially, they retained the legal option to reconsolidate those assets in the future.
Right. But reconsolidation would require a shift in the broader federal regulatory environment. Specifically, the federal legalization of adult use cannabis, or at least a targeted change in NYSE listing rules regarding state legal adult use operators.
Exactly. But if federal adult use legalization ever actually happens, does Trulieve just snap those massive, high-volume, revenue-generating assets right back onto their balance sheet overnight?
Wow.
I mean, they may have just engineered a massive financial Trojan horse. Think about it. They get the immediate benefits today: a lower cost of capital, institutional liquidity, the prestige of the NYSE, while secretly parking their highest volume adult use assets right outside the city gates, just waiting for the federal green light.
That's a fascinating way to look at it.
It really makes you wonder if the retail market has fully priced in the true latent value of that 90% retained economic interest. So keep an eye on that specific metric. If federal laws shift, that Trojan horse might just open its doors. Make sure you follow the show for your daily deep dive into earnings coverage so you never miss what's hiding behind the accounting noise.